I'm Professor Moran, Microeconomics 112. We're beginning a unit on types of business competition: pure competition, monopolistic competition, oligopoly, monopoly, listed from best for society to worst for society. In order to distinguish them, we need to understand costs. So costs will be critical to all of the other units, so there's one chapter on its own concerning costs. Costs are very important for a firm to understand. For example, is there any wasteful spending going on? Is the company spending something on, in particular, that if was eliminated could increase profits given a certain amount of revenue? So expenses on different things have to be classified into accounts, and then those accounts are sorted based on, for example, sales or revenue or costs, and then sales minus cost equals profit. So you want to look at costs, and you want to match costs to items sold, and then see which product might be more profitable by taking its sales dollars and minus the cost to make that product and getting a profit margin and doing that for other products. So costs are so important that there are a variety of ways of looking at them, and it can be quite disorienting for students. It's a lot of vocabulary, and there are distinct ways of looking at costs because they're so important. So try to hang in there. Just keep that in mind, that there are many different ways of looking at it. Okay, first way we're going to look at costs is explicit versus implicit costs. Explicit costs are what you think of as costs. They're the money expenses of a firm. They're accounting costs. These explicit costs are the cost of using or buying resources owned by someone else. No big deal. A company wants an assembly line. They got to buy the assembly line from another company, pay for it, and now it's theirs to use. Implicit costs, though, are opportunity costs. And remember, an opportunity cost is what you give up to get what you get. So if you choose to stop using a car for yourself or a business of yourself and use it in another line of work, then you're going to lose that revenue from the alternate use. So it's an opportunity cost. An opportunity cost is using resources owned by the firm. For example, if you go into work, if you open up your own business, you've lost the amount of money you could have made as a laborer. So here's an example of classifying expenses as implicit or explicit. These will be explicit costs of the firms. These are going to be implicit costs of the firm, also known as economic costs or implicit costs. They are revenue foregone because they are now being used in this line of activity. So let's say someone opens up a shirt printing company, and they sell $120,000 worth of printed shirts. It takes $120,000 to buy the shirts. It takes $40,000 to buy the shirts. He has to pay workers $18,000. Pays utilities of $5,000. This is money expenses of the firm. They're actually cutting checks, laying it out, and that's a total of $63,000 expenses for the firm. $120,000 worth of revenue minus $63,000 of costs equals an accounting profit of $57,000. At this point, the CPA drops his pen, charges you, and walks out of the room. But the economist has to come along and tell you if you're actually doing a sensible thing. And you do that with implicit, also known as economic costs. They're opportunity costs. That's what this word foregone is here. So let's say this person took money out of the bank for which he used to receive $1,000 interest to use in this business. So he's not receiving the $1,000 anymore. It's an implicit cost. He uses his own building to run his little factory, for which he was paid $5,000 in interest. But now he's not getting that $5,000 in interest because he's using it to run his own business. He used to have a job, and he got paid $22,000 for it. Since he's not working there anymore, he gave up that $22,000 to run his own business. Now, each job, as a boss, has a certain level of, say, aggravation or extra responsibility attached to it that an employee does not have. And we're going to call that a normal profit. So someone needs to be compensated a little more than their old job in order to undertake the responsibilities of being a boss. So for a shirt owner of a shirt printing company, maybe it's $5,000. If it's the amount of entrepreneurial expertise to run Microsoft Windows, it could be millions of dollars. In this example, let's assume that it's $5,000. Add these up and you'll get $33,000. So this person gave up $33,000 in order to go into the shirt making factory. So we take the accounting profit of 57 and minus out what he gave up to run the shirt factory by doing other things, using resources he personally owns that earned money in alternate uses, but now he's using for the factory. He gave up $33,000. 57,000 explicit costs minus 33,000 implicit or economic costs gives us an economic profit of $24,000. So this is a sensible thing to do. We're making this idea explicit. You would know to do this intuitively. You wouldn't quit a job that made $100,000 to take a job worth $57,000. So if you had a job that was paying $100,000, for example, and you quit it, that is now an implicit or economic cost of taking another job. You'd only take the other job if the economic profit was greater than the implicit costs you gave up. So a $120,000 job you would take and give up a $100,000 job because it would have an economic profit of $20,000. But you wouldn't accept a job that paid $80,000 and give up a job that paid you prior $100,000 and have a $20,000 economic loss. So you do this intuitively. We're now making it explicit so we can understand the concept better. Now, let's do an example. So now we're going to do an example in our next video.